All right, so before we talked about income, now let's flip it. Most people think expenses are simple. I pay the bill, therefore that's the expense. But that's not actually true either. Just like income, there are two timelines happening at the same time. In your system, income is earned before it's paid. Expenses are incurred before they're paid. And if you don't separate those two things, your entire financial picture becomes distorted. So let's look at some timelines. In timeline 1, we have economic value consumed. This is where you are using electricity every single day. That's when the expense actually happens. In timeline number 2, you have the payment timeline. You receive the bill later. You pay it even later. Payment is delayed. So let's say that your bill covers February the 27th to March the 26th. The month end is March 31st. That means March 27th to March 31st has been used but not billed yet. If you ignore this, your March expenses are understated. So of course, that raises the question of how do we make the adjustment, or what is the adjusting entry? So at month end, we fix the timing, and this is in our adjusting entries process at month end. We record the expense when it actually occurred. So we debit our utilities expense account and we credit our accrued utilities payable for the amount that considers the economic value that was consumed during that period. Now your expense reflects reality and your liability reflects what you owe. And this is called an accrued expense. And specifically, you're going to write this into your accounts payable because it's an accounts payable account in your liabilities. Now, one other complication is that typically the utilities bill covers a short period at the end of the prior month, and it doesn't include the total period of the current month. And so what this means is that you're going to have to make an estimation. And a good way to do this is to take the total amount of your bill and divide it by the total number of days that the bill covers. That'll give you sort of the daily consumption rate. And let's say that there's 4 days that are missing at the end of the period. You're going to want to take that 4-day period and multiply it times that daily rate that you've calculated. Again, this is to make sure that you include the amount that you've consumed, or at least your best estimate on the amount that you've consumed for the month. Now, if you had done this in the prior period, then you would have had an estimation there as well. So you're going to want to, when you make the payment, just make sure that you adjust for any differences between what you've estimated and what the bill actually was. Okay, so that is one complication that you'll have to take care of, and it introduces estimates. And the estimates are reasonable because, from during a couple of different months, the weather doesn't swing so enormously to make the difference or to make the daily rate that much different from the beginning of the month till the end of the month. You can toy with your estimation procedures, but for simplicity's sake, we would take the daily rate and multiply it by just the remaining days to estimate for month end. So when the bill finally arrives, it contains two things: what you already accrued and new usage since then. So your entry in your personal financial operating system or in your journal is going to be, you're going to debit your utilities expense, you're going to debit your accrued utilities payable, and you're going to credit your accounts payable. Then when you pay the bill, you're going to debit your accounts payable, so that clears out the liability, and you're going to credit cash. So notice what's happening. You're not recording the expense when you pay, you're simply settling an obligation. So what's the big insight here? Here's the shift. The bill didn't create the expense. It simply confirmed it. The expense happened when the electricity was used. So your system is powerful. The journal records, the ledger organizes, and the statements summarize. But everything depends on one step. Did you interpret the transaction correctly? Again, it comes down to you analyzing and interpreting that transaction, what the economic event was and what the cash flow was. The system handles the mechanics, you handle the thinking. So here's the big takeaway. Most people, they track payments and they ignore timing. But now you're doing something different. You're separating the economic consumption from that cash payment. And that's what gives you a true financial picture. In closing, now you understand both sides. Accrued income, assets, that's when you are faced with a timing difference between receiving your paycheck and earning the income. And now accrued expenses, which are captured in the creation of that account payable or that utilities payable liability. You're not tracking bills, you're modeling reality. Most people track cash, and now you understand financial truth.